More than 7 million student loan borrowers are expecting an increase in their monthly costs.
Chapter 1. The Setup. You are 18 years old. You have never signed a legal contract in your life. You do not know what an interest rate really means. You have never seen a loan amortization schedule. And someone hands you a stack of paperwork and tells you to borrow $50,000. Not for a house, not for a business, for a degree you have not started yet, in a field you are not sure about, that may or may not lead to a job that may or may not pay enough to cover what you just borrowed. You sign. 44 million Americans have signed that same stack of papers. Together, they carry over $1.77 trillion in student loan debt, according to the Federal Reserve. That is more than all the credit card debt in the United States. More than all the auto loan debt. The only consumer debt category larger is the mortgage market.
Back now with a ticking clock for student loan borrowers. Payments are set to resume in October, but as Brian Chung reports, some say they can't afford to pay.
And unlike a mortgage, there is no house attached to the loan. No asset that can be sold if things go wrong. Just a piece of paper that says you went to school. This is the student loan trap. And what makes it so effective is not the debt itself. It is the fact that you are asked to take it on before you have any idea what it is going to cost you. Chapter 2. How it started. College as an investment, not a right. American higher education was not always a debt-driven system. After World War II, the GI Bill sent millions of veterans to college almost entirely at government expense. State universities in the 1960s and 1970s charged tuition that a student could cover by working a part-time summer job. The University of California system, one of the most prestigious public university systems in the world, was essentially free to California residents until the 1970s. Then something shifted. States began cutting funding to public universities. Universities, no longer fully subsidized, began raising tuition. The federal government, rather than replacing that lost funding with direct grants, responded by expanding the student loan program.
60 and older are struggling to pay an estimated $86 billion in student loan debt. They are racking up student debt faster than any other group.
The logic was that if college increased lifetime earnings, students should be willing to borrow to finance that investment. The returns would pay back the debt. The problem is that this logic assumed tuition increases would be modest. It assumed graduate salaries would keep pace. It assumed the labor market would reliably reward a four-year degree the way it had in the 1950s and 1960s. None of those assumptions held. Between 1980 and 2023, the average cost of a four-year college education rose by over 1,200%, adjusting for inflation, according to data from the National Center for Education Statistics. Median wages for young workers over the same period rose by roughly 19% in real terms. The gap between what college costs and what it pays you to attend it has been widening for 40 years. Student loan debt is what fills that gap. Chapter 3. The Mechanics. How student debt actually accumulates. Most people think about student debt as a single number. You borrow $50,000. You owe $50,000. Simple. It is not simple. Federal student loans come in several forms. Subsidized loans, which are need-based, do not accrue interest while you are enrolled in school. Unsubsidized loans start accruing interest the day the money is dispersed, even while you are still sitting in class. Plus loans, which parents or graduate students take out, carry higher interest rates and begin accruing immediately with no grace period. Here is what that means in practice. A student who borrows $27,000 in unsubsidized federal loans as an undergraduate, the current average federal loan balance per borrower, according to the Education Data Initiative, starts school with a $27,000 balance.
Students graduating with debt from in-state public universities, that's also down about 60% during the same time frame.
If that student takes 4 years to graduate and never makes a single payment during school, which is the default arrangement, the interest accrues daily. By graduation day, the actual balance owed is already several $1,000s higher than the amount borrowed. Then there's a 6-month grace period before repayment begins. More interest. Then repayment starts on the now inflated balance. A borrower who entered school thinking they borrowed $27,000 sits down to their first loan statement and discovers they owe $30,000 or $32,000. They have not made a single payment. They have not missed a payment. They have simply existed. For graduate and professional school borrowers, the numbers are dramatically larger. The average law school graduate carries $130,000 in student loan debt, according to the American Bar Association. The average medical school graduate carries over $200,000. Those balances accumulate across 3 to 7 years of graduate school, accruing interest the entire time, before a single dollar of repayment is made. Chapter 4. The Income-Driven Repayment Illusion.
Recent changes to student loans have woken up Westminster to what anybody who did a degree in the 2010s, and probably their parents, already know.
Here is where the student loan system reveals its most sophisticated trap, and it is disguised as a solution. When borrowers cannot afford their standard student loan payments, the federal government offers income-driven repayment plans. Under these plans, your monthly payment is capped at a percentage of your discretionary income, typically 10 to 20%. If your income is low enough, your payment can be zero. After 20 or 25 years of payments, the remaining balance is forgiven. On the surface, this sounds like a safety net, and for some borrowers, it genuinely is. But here is what income-driven repayment actually does for most borrowers who enroll in it. It reduces your monthly payment below the amount of interest accruing on your loan every month, which means your balance does not go down, it goes up. You are making payments every month and still watching your student debt grow. This is called negative amortization. It happens when monthly payments do not cover interest charges. In a mortgage, negative amortization is considered predatory and is heavily regulated. In the federal student loan program, it is a standard feature of the most common repayment plans. A borrower who takes out $50,000 in student loans, enrolls in income-driven repayment, and makes consistent payments for 20 years may arrive at forgiveness with a balance of $80,000 or $100,000, having paid tens of thousands of dollars along the way and still owing more than they originally borrowed. The forgiveness is real, but reaching it requires 2 decades of financial limbo. And until very recently, that forgiven balance was treated as taxable income by the IRS. A borrower who had $60,000 forgiven could face a tax bill of $15,000 or more the same year they thought they were finally free. The so-called forgiveness event was itself a trap. Chapter 5, the compounding problem, when student debt follows you forever. There is one feature of federal student loans that separates them from nearly every other form of debt in American law. And it is the feature that makes student debt genuinely different from a mortgage or a car loan. Student loan debt is almost impossible to discharge in bankruptcy. Under the 1976 Higher Education Act and subsequent amendments, student loans were carved out of standard bankruptcy protections. To discharge student debt in bankruptcy, a borrower must prove undue hardship through a separate legal proceeding called an adversary proceeding. The standard is notoriously difficult to meet. Courts have historically required borrowers to prove not just current inability to repay, but a near certainty that their financial situation will never improve. Poverty today and poverty forever, essentially.
Amna, it's called Saving on Valuable Education, or SAVE. It bases borrowers' monthly payments on their incomes and provides a...
The result is that student loan borrowers carry their debt through job losses, medical crises, divorces, and recessions in a way that credit card holders and even mortgage borrowers do not. A mortgage default leads to foreclosure. A credit card default leads to collections and eventually a dischargeable bankruptcy. A student loan default leads to wage garnishment, seizure of tax refunds, and the suspension of professional licenses in many states, all while the balance continues to grow. According to the Brookings Institution, roughly 40% of student loan borrowers are expected to default at some point before 2023. That number was published before the pandemic payment pause. The post-pause default picture is still emerging, but early data from the Department of Education suggests millions of borrowers are struggling to re-enter repayment. When you cannot pay the debt and cannot discharge the debt, you are in a trap with no exit. Chapter 6, the universities. Who profits when students borrow? Let's talk about where the money actually goes. When a student takes out a federal student loan, the money does not go to the student. It goes directly to the university. The student becomes the borrower. The university collects the tuition, and then the student spends the next 10 to 25 years repaying a debt incurred on the university's behalf. Universities, particularly private universities, have remarkably little financial exposure to student loan default. If the graduates cannot repay their student debt, the university does not lose money. The federal government absorbs the loss. The university has already been paid. This insulation from risk has allowed universities to raise tuition with almost no market discipline. A normal business that charges too much loses customers. A university that charges too much does not lose students as long as federal student loans are available to cover the cost. The availability of student debt financing has functionally removed the price ceiling from higher education. This is the mechanism economists call the Bennett hypothesis, named after former Secretary of Education William Bennett, who argued in 1987 that federal financial aid was enabling tuition inflation rather than offsetting it. Decades of research have broadly supported his thesis. A 2015 study published in the American Economic Review found that for every dollar of federally subsidized student loan availability, institutions raised their prices by roughly 60 cents. Meanwhile, university endowments at the wealthiest institutions have grown to extraordinary levels. Harvard's endowment exceeded $50 billion in 2023. Yale's exceeded $40 billion. These institutions charge full-paying students $80,000 to $90,000 per year, while sitting on enough invested capital to fund their operating budgets indefinitely without charging tuition at all. The student loan system has enriched American universities dramatically. The students who funded that enrichment are still paying. Chapter 7, the for-profit college catastrophe. If the traditional university student debt story is concerning, the for-profit college chapter is something else entirely. For-profit colleges. Institutions like Corinthian colleges, ITT Technical Institute, DeVry University, and the University of Phoenix at its peak were built almost entirely on the federal student loan system. They recruited aggressively, often targeting low-income students, veterans, and working adults with promises of career training and job placement. They accepted nearly every applicant, and because their students had access to federal financial aid, tuition revenues flowed in regardless of educational outcomes. The results were catastrophic for hundreds of thousands of borrowers. Corinthian colleges enrolled roughly 72,000 students at its peak. It collapsed in 2015 after federal investigations found systematic fraud in job placement statistics and misrepresentation of outcomes. Thousands of borrowers were left with worthless credentials and student debt they could not repay. ITT Tech shut down in 2016 under similar circumstances, affecting 35,000 students. The Department of Education's own data showed the graduates of many for-profit institutions had median earnings after graduation that were lower than the earnings of workers with only a high school diploma. Students borrowed $20,000, $30,000, $50,000 for credentials that the labor market valued at almost nothing. The federal government has paid out billions in loan discharges related to for-profit fraud, but many borrowers waited years or decades for relief that came too late to prevent the financial damage to their careers, credit scores, and retirement savings. The for-profit college sector was a massive wealth transfer from low-income student loan borrowers to private equity-backed education companies. It was legal, it was systematic, and it was made possible entirely by the availability of federal student loans with no performance standards attached. Chapter 8, the racial wealth gap and student debt.
You know, to look back and see my parents in the stands crying and celebrating, like that's when I knew, like, okay, this is...
The student loan burden is not distributed evenly, and the unevenness tracks almost precisely along the racial wealth gap. Black college graduates borrow at higher rates than white college graduates, borrow larger amounts, and have significantly more difficulty repaying. According to a study by the National Center for Education Statistics, Black bachelor's degree graduates are 3 times more likely to have taken out student loans than white graduates. 4 years after graduation, Black graduates owe, on average, nearly twice as much student debt as their white counterparts, even when controlling for income and type of institution attended. The reason is not primarily behavioral, it is structural. White college students are more likely to have family financial support that reduces or eliminates borrowing. White families hold significantly more generational wealth, largely because of decades of exclusionary housing policies that prevented Black families from building home equity during the post-war era. That generational wealth translates directly into less student debt, lower monthly payments, and faster wealth accumulation after graduation. A white student who graduates with $20,000 in student debt and a family safety net, parents who can help cover rent for a year, who might absorb an emergency expense, is in a fundamentally different financial position than a Black student who graduates with $35,000 in student debt, with no family safety net, and maybe the family's financial support, not a recipient of it. The student loan system was designed as a democratizing force, a mechanism to give everyone access to higher education regardless of family wealth. In practice, it has replicated and in some cases amplified existing wealth disparities, because it puts the cost of education onto the borrower without accounting for the very different starting points borrowers bring to that obligation. Chapter 9, the hidden cost on life decisions. Student debt does not just sit in a spreadsheet, it reshapes entire lives in ways that do not show up in default statistics. Research from the Federal Reserve Bank of New York found that each $1,000 increase in student loan debt reduces the probability of homeownership by about 1 to 2 percentage points for borrowers in their late 20s. At average student debt levels, that translates into a meaningful delay in or outright elimination of homeownership for millions of people, which is the primary wealth-building vehicle for the American middle class. Student debt delays marriage. A study published in the journal Family Relations found that student debt burden is consistently associated with delayed family formation, particularly among men with high debt loads. It delays children, it restricts geographic mobility because borrowers cannot afford to take risks on new cities or career pivots when monthly student loan payments are mandatory. There is also the career distortion effect. A 2014 study in the Journal of Human Resources found that law school graduates with higher student debt were significantly more likely to enter corporate law and significantly less likely to enter public interest law, regardless of their stated career preferences before school. Student debt does not just constrain what you can afford, it constrains who you become. The doctor who wanted to work in a rural, underserved community cannot afford to on a nonprofit clinic salary with $220,000 in student debt. The teacher who went to an expensive private university faces a starting salary of $38,000 and a $400 monthly student loan payment. The social worker who believed in the mission discovers the salary does not service the debt. Student loan debt reshapes the labor market away from public service and toward the highest paying private sector jobs, not because of individual greed, but because of financial survival. Chapter 10, the loan servicer problem. Even if you understand your student loan balance and your repayment options, there is one more layer of dysfunction standing between you and a manageable situation. The servicer. Federal student loan servicers are private companies contracted by the Department of Education to manage billing, repayment plans, and borrower communication. These companies, Navient, Great Lakes, Mohella, and others, are paid per borrower and have a financial incentive to keep borrowers in whatever status requires the least servicer effort, not necessarily the status that is best for the borrower. A 2017 lawsuit filed by the Consumer Financial Protection Bureau against Navient, which at that time serviced roughly $300 billion in federal and private student loans, alleged that the company had systematically steered borrowers into forbearance, which pauses payments but lets interest accumulate, rather than into income-driven repayment plans that would have better served borrowers. The CFPB alleged that this was because forbearance was faster to process and required less servicer work. The Government Accountability Office has documented repeated cases of servicers providing inaccurate information about repayment options, miscalculating qualifying payments toward public service loan forgiveness, and failing to process income-driven repayment applications correctly. For borrowers, this means that even doing everything right, making every payment on time, applying for every program you qualify for, you may still find years later that your payments were not counted correctly, your forgiveness timeline was reset, or you were put in a status you never agreed to. The student loan system is not just structurally difficult, it is administratively hostile to the people it is supposed to serve. Chapter 11, The Political Football. Forgiveness, Backlash, and What Actually Happened. Student loan forgiveness became one of the most politically charged economic debates of the early 2020s, and the story of what actually happened reveals a great deal about how the system works and who it is designed to protect. During the COVID-19 pandemic, the federal government paused student loan payments for over 3 years, from March 2020 through October 2023. For the first time in decades, tens of millions of borrowers were not making monthly payments. The sky did not fall. The economy did not collapse. In fact, economists broadly found that the payment pause contributed to consumer spending and economic recovery. The pause also revealed something important. Many borrowers had completely restructured their financial lives around not having a student loan payment. They bought homes, they started businesses, they built emergency funds, they had children. The student debt system had been quietly suppressing economic activity at a scale that only became visible when the debt was briefly removed. The Biden administration attempted broad student debt cancellation of $10,000 per borrower, $20,000 for Pell Grant recipients. The Supreme Court struck it down in 2023 in Biden versus Nebraska, ruling the administration had exceeded its statutory authority. The decision left roughly 40 million borrowers in the same position they started. The administration then pursued narrower cancellation through other legal mechanisms, discharging debt for defrauded borrowers, public service workers whose forgiveness applications had been improperly denied, and borrowers who had been in repayment for decades. Approximately $167 billion in student debt was canceled through these targeted programs by early 2024, according to the Department of Education. But the structural problem, the gap between what college costs and what people earn, the servicer dysfunction, the impossible bankruptcy standard, the front-loaded interest on unsubsidized loans, none of that changed. Forgiveness addressed some of the symptoms. The disease is still running. Chapter 12, What Actually Helps. Strategies for borrowers right now. None of this is meant to be fatalistic. There are real decisions that real borrowers can make right now that significantly change their outcomes. The most important thing most borrowers do not do is understand which repayment plan they are on and whether it is actually the right one. Millions of borrowers are in standard 10-year repayment by default, making payments they cannot afford when they qualify for income-driven plans that would lower their payment immediately. Others are in forbearance, accumulating interest when an income-driven plan with a $0 payment would give them the same short-term relief without negative amortization. Log into studentaid.gov, look at your loan types, your servicer, your current repayment plan, and your balance. Then use the Loans Simulator tool on that site to compare what different repayment plans would cost you over time. This free tool does the math the servicer often will not do for you. Public service loan forgiveness is genuinely powerful for borrowers who qualify, meaning anyone working full-time for a government agency or qualifying nonprofit, including teachers, social workers, public defenders, and federal employees. After 10 years of qualifying payments under an income-driven plan, the remaining student debt balance is forgiven tax-free. The program has historically had an atrocious approval rate because of administrative failures, but reforms in recent years have improved it meaningfully. If you work in public service and carry student debt, this program should be at the center of your financial plan. For borrowers in the private sector with manageable debt loads, aggressive repayment is often the highest return financial move available. Paying off a 7% student loan is equivalent to earning a guaranteed 7% return on that money. In an uncertain market, that is not a bad investment. The most dangerous position a student loan borrower can be in is passive. Just paying whatever the default bill says, not knowing your options, not tracking your balance, not asking whether your payments are being applied correctly. The system is complicated by design. The people who navigate it best are the ones who learn the rules. Chapter 13, The Hidden System. What Student Debt Reveals About America. Here is the deeper truth underneath all of this. The student loan crisis is not really about education. It is about what happens when a society decides that a basic requirement for participation in the middle class should be financed privately rather than funded publicly. Every other developed country in the world has made a different choice. Germany charges no tuition at public universities for domestic and international students. Norway provides free higher education with additional student stipends. The United Kingdom charges tuition but caps repayment at a percentage of income, with remaining debt written off after 30 years. Canada's provincial loan programs are far more generous. Australia uses an income contingent repayment system where payments only trigger above a minimum income threshold and the real interest rate is capped. The United States chose to treat higher education primarily as a private investment to be financed through private debt. Then it built a lending system, a servicing infrastructure, and a legal framework that protected lenders and universities while maximizing extraction from borrowers. The $1.77 trillion in outstanding student loan debt is not the result of irresponsible young people making bad decisions. It is the result of a 40-year policy experiment in privatizing educational access that has produced exactly the outcomes you would predict. Enormous wealth for the institutions that provide education, enormous debt for the people who consume it, and a widening wealth gap between those who can afford to avoid the debt and those who cannot. The borrowers did not design this system. They were born into it. Closing reflection. If you are carrying student loan debt right now, do one thing before this video ends. Go to studentaid.gov and log in. Look at your current repayment plan, your balance, and your servicer's contact information. Then use the loan simulator to see what an income-driven plan would cost you compared to what you are paying now. It takes 15 minutes, and it might save you thousands of dollars. If you are a parent of a college-bound student, start that conversation early. The debt your child takes on at 18 will follow them for a decade or two. The time to talk about it is before the applications go in, not after the acceptance letters arrive. And if you know someone drowning under student debt who does not know their options, share this video with them. Because the number one reason people stay stuck in the worst possible repayment situation is that nobody ever explained how the system actually works. The student loan trap is real, but it is a trap with doors. You just have to know where they are.